London. Reuters. Britain's Brexit-bound economy remains stuck in a low gear but is probably not weak enough to dissuade the Bank of England from raising interest rates next month, economic data showed. Separately on Tuesday, Britain's budget forecasters gave a gloomier medium-term outlook for the economy, potentially leaving Finance Minister Philip Hammond with less room to offset any big hit from Britain's departure from the European Union. The somewhat downbeat picture for the world's fifth biggest economy from a raft of data including a record goods trade deficit contrasted with the situation in some of Britain's closest trading partners in the European Union. German exports outpaced imports in August, adding to signs it performed strongly in the third quarter, and Italian industrial output was much stronger than expected. But there were some signs of encouragement for Britain. The country's factories had their strongest 2 months of 2017 in July and August, and the construction sector grew for the first time in 3 months. In year-on-year terms, factory output was 2.8% higher, its fastest growth in 6 months. Revisions to past data showed Britain's economy had been a bit less weak earlier this year than previously thought. They're not storming figures, but I think they're good enough to keep the Bank of England on track for a November rate hike, said Victoria Clark, an economist with Investec. Britain's economy has slowed sharply this year as consumers felt the pinch from rising inflation, caused largely by the fall in the value of the pound after the Brexit vote, and by weak wage growth. File photo. A man unloads Volkswagen cars from a car transporter outside a car showroom at Portslade near Brighton in southern England, Britain, April 24, 2013. Reuters. Luke McGregor. File photo. Nonetheless, the BO said last month that most of its policymakers thought it was likely that they would need to raise rates for the first time in a decade in the coming months. The BO believes last year's Brexit vote will create more inflation pressure by dampening business investment and slowing migration to Britain. Sterling rose after Tuesday's official data and British government bond prices edged down. GBP figures for the much bigger services sector are due to be released on October 25, along with a preliminary first estimate for third-quarter gross domestic product growth, little more than a week before the BO's November 2 announcement. Many economists say only a shock weakening in those figures is likely to cause the BO to delay raising rates. In a reminder of the long-standing problems that have held back Britain's economy, Tuesday's data showed the country's deficit in its trade and goods hit an all-time high in cash terms. That was despite the slump in the value of the pound, which some supporters of Brexit have predicted will deliver an export boom. Export volumes in the 3 months to August were 3.2% lower than the previous 3 months, though they are 8.9% higher than a year before. And there was bad news regarding the Achilles heel of the British economy, the long-standing weak record of its companies and workers to squeeze more output from their work. Britain's official budget watchdog said it expected to significantly downgrade its forecasts for productivity growth in the next 5 years. Finance Minister Hammond is due to present an annual budget on November 22. Although he is under pressure to increase public spending and eliminate a pay cap on public sector pay, any cut in productivity forecasts would substantially limit his room for maneuver by reducing future tax revenues. Additional reporting by Andy Bruce, editing by Alison Williams or Standards. The Thomson Reuters Trust Principles.